Seeds of Wisdom RV and Economics Updates Saturday afternoon, July 20th, 24. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Jordan launches National Technology Network. The Ministry of Digital Economy and Entrepreneurship in Jordan has launched a national blockchain technology network in partnership with Jordanian blockchain company BlockX. The implementation of blockchain technology in Jordan's government sector aligns with the Jordanian Digital Transformation Strategy, 2021 to 2025. Enhancing trust in government services. On July 17, the Jordanian Ministry of Digital Economy and Entrepreneurship announced its partnership with local blockchain company BlockX to launch a national blockchain technology network called Mode DLT. This protocol aims to enhance trust and transparency in government services. The blockchain network has been integrated with the Jordanian government portal, allowing for decentralized and verifiable digital records of all Sanad transactions. According to a report, this implementation aligns with the Middle Eastern nations' digital transformation strategy, 2021 to 2025, which focuses on strengthening the country's digital infrastructure. Under Jordan's ambitious strategy, innovation, as well as private and public sector partnerships, are seen as key enablers, hence, they are encouraged. Investments in critical information technology infrastructure, including broadband expansion and 5G deployment, are similarly viewed as important enablers. When achieved, these and 5 other enablers help Jordan improve the quality of life for its citizens. Meanwhile, the ministry emphasized that utilizing the blockchain network across various government sectors will create a reliable digital environment, supporting the kingdom's broader goals of achieving a robust and trustworthy digital economy. In addition to enhancing trust in government, this initiative aims to streamline the integration of e-government services, making them more transparent, efficient, and competitive both locally and internationally. Bank of International Settlements issue new rules for XRP. The BIS, which positions itself as a bank for central banks globally, has introduced new regulations governing banks' exposure to Group 2 cryptocurrencies. Notably, the BIS had in the past defined what Group 2 crypto assets are in an effort to separate them from other cryptocurrencies. Group 2 assets include unbacked crypto assets such as XRP, Bitcoin, BTC, and Ethereum, ETH. The category also contains stablecoins that lack effective stability mechanisms. According to the BIS classifications, these assets are riskier due to their volatility. In the latest requirements, the BIS has stipulated that a bank's total exposure to all these Group 2 assets must not exceed 1% of its Tier 1 capital. For the uninitiated, the Tier 1 capital represents a bank's core capital. This capital is the primary financial buffer that absorbs losses, ensuring the bank's stability. Per the BIS requirement, if a bank with $1 trillion in Tier 1 capital seeks to hold XRP and other assets in Group 2, the combined worth of all assets must not be more than $10 billion. Crypto regulations have taken focus in recent times as the industry pushes further into the mainstream scene. For instance, the European Union recently enacted the first part of its MiCA regulations, affecting stablecoins. Mainstream banks have begun gaining exposure to crypto assets. Recall that last December the Basel Committee disclosed the crypto holdings of 19 banks across different regions. The disclosure confirmed that these banks held $205 million in XRP at the time. Despite this, XRP has not commanded as much adoption from banks and financial institutions due to the ongoing SEC lawsuit. Anderson, a crypto researcher, argued in February that XRP might not see increased adoption by banks until the US SEC publicly declares it is not a security. Per the publication, the BIS recent requirements are set to take effect on January 1, 2026. The Central Bank of the UAE, CBUAE, and National Bank of Ethiopia, NBE, have signed an agreement to enhance financial and commercial cooperation between the two nations, in a deal worth 3 billion United Arab Emirates dirhams. Both parties also entered into 2 Memorandum of Understanding, MO, to establish a framework for the use of local currencies in settling cross-border transactions and for linking their payment and messaging systems. The agreement allows the CBUAE and the NBE to swap local currencies with a nominal value of up to 3 billion United Arab Emirates dirhams and 46 billion Ethiopian birrs, supporting the financial and commercial cooperation between the UAE and Ethiopia through the provision of liquidity in local currencies to financial markets, enabling more effective and efficient settlement of cross-border transactions. Both parties will cooperate under the second MO in the areas of payment platform services and electronic switches, by interlinking their instant payment systems, national card switches UAE switch and ETH/SWITCH, and messaging systems in accordance with the regulatory requirements of each country, in addition to the cooperation in the field of financial technology and central bank digital currencies. The bilateral currency swap agreement and the MO signed today reflect the robust economic cooperation between the UAE and Ethiopia, specifically in the areas of trade and investment. Swapping the currencies of the two countries and utilizing local currencies to settle cross-border transactions and enhancing the cooperation in interlinking instant payment systems. Electronic switches and messaging systems will enhance economic, trade, and investment prospects. Quote, "The currency swap arrangement provides an important funding opportunity for Ethiopia and helps diversify the range of currencies at its disposal to facilitate the growing volume of trade and investment transactions expected over the coming years." Currency swaps. Definition: how and why they're done. A currency swap involves the exchange of interest, and sometimes of principal, in one currency for the same in another currency. Companies doing business abroad often use currency swaps to get more favorable loan rates in the local currency than if they borrowed money from a local bank. Considered to be a foreign exchange transaction, currency swaps are not required by law to be shown on a company's balance sheet. Interest rate variations for currency swaps include fixed rate to fixed rate, floating rate to floating rate, or fixed rate to floating rate. Currency swaps were originally done to get around exchange controls, governmental limitations on the purchase and/or sale of currencies. Although nations with weak and/or developing economies generally use foreign exchange controls to limit speculation against their currencies, most developed economies have eliminated controls nowadays. So swaps are now done most commonly to hedge long-term investments and to change the interest rate exposure of the two parties. Companies doing business abroad often use currency swaps to get more favorable loan rates in the local currency than they could if they borrowed money from a bank in that country. Currency swaps are important financial instruments used by banks, investors, and multinational corporations. In a currency swap, the parties agree in advance whether or not they will exchange the principal amounts of the two currencies at the beginning of the transaction. The two principal amounts create an implied exchange rate. For example, if a swap involves exchanging 10 million euros versus $12.5 million, that creates an implied USD exchange rate of 1.25. At maturity, the same two principal amounts must be exchanged, which creates exchange rate risk as the market may have moved far from 1.25 in the intervening years. Quote, "Digital Russian Ruble CBDC. Putin wants to speed up deployment of Russia's CBDC." During a meeting on economic issues earlier this week, Vladimir Putin seemed keen for Russia's central bank digital currency, CBDC, pilots to accelerate, according to Russian news agency TASS. "Now we need to take the next step, namely to move to a broader, full-scale implementation of the digital ruble in the economy, in economic activity and in the field of finance," he said. Digital ruble trials started in August last year after months of delays waiting for supporting legislation. The first wave of tests involved a dozen banks, with a second wave due to start in September with up to 19 additional banks, including Russia's largest, Sber. It is important for Russia to seize the moment, as they say, to create the legal framework and regulation in a timely manner, to develop infrastructure, to create conditions for the circulation of digital assets, both within the country and in relations with foreign partners, he said. Russia already has a digital financial asset, DFA, framework for tokenized assets, including commodities such as gold. The usage of DFA such as tokenized gold for payments is banned. However, the country recently passed legislation supporting their use for cross-border payments. Plus, Iran said it was working with Russia on CBDC and tokenized asset payments. Likewise, the central bank governor recently said that it was acceptable to use cryptocurrencies for international payments if it helps address sanctions. This underlines Putin's desire to accelerate other modes of payment, particularly new digital technologies such as CBDC and digital assets that sidestep the West. CBDC adoption is a matter of when, not if. Reserve Bank of India, RBI, released a central bank digital currency, CBDC, called the digital rupee in 2022. The digital rupee is supposed to carry the same force as traditional currency. Paddy mentioned that the regulator sees CBDC as a product for the future, with 140 countries exploring CBDC at various stages. At some point of time, we would see that CBDC provides a good, safe and secure alternative to cash, and reduces our dependence on currency. This would also reduce the need for printing, distributing, retrieving back those currency notes and replenishing them, Paddy pointed out. RBI's Chief General Manager for the FinTech Department, Suvendu Paddy, said during Asacham's India International FinTech Festival, "We didn't want to impinge on fintechs because they are at different stages of development and they require treatment that improves their innovation," Paddy mentioned. Paddy emphasized the utility of CBDCs for cross-border money transfers. He said that cross-border payments have three challenges. 1. High remittance costs. 2. Timelines for payments, time zone restrictions. 3. The lack of adequate transparency in tracking money back to the receipt. CBDC, through its technology and tokenized way of transfers, offers to break all these barriers and restrictions, he mentioned. He added that India has entered into pilot agreements with a few countries and joined multilateral projects to this effect. This is one area where I would encourage, apart from the traditional banks which are a part of the CBDC distribution systems. Fintechs and NBFCs should also enter this segment because the potential for innovation is immense, he said, adding that the regulator has started programmability as a part of CBDC to monitor the end use of the currency. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Source: Dinar Recaps.